Howdy, Jacob here. Today we're looking at Nordic American Tankers. $876 million market cap, $1.037 billion enterprise value. It's in the oil, gas, and consumable fuels industry. Looks like they acquire and charter double hull tankers in Bermuda and internationally. Incorporated in 1995. Currently has a 5.59% dividend yield. Okay, let's look at that debt. Not a whole lot of net debt. Let's see what it is in relation to free cash flow. So 250 million in 2012, now 266 million in long-term debt, 60 million cash on hand. All right, so roughly 260 of their long-term debt, and 5-year average 10 million negative, 100 million, 50 million negative. I guess positive from a capital expenditure, positive, must have sold off something. So maybe a 5-year average. I mean, it's a very cyclical business, especially in relation to their free cash flow. So their current dividend yield is paying out 79 million. Really, 79 million. That's a lot in comparison to a 5-year average. I mean, there's a lot of negatives there, but we can say maybe it's averaging like 40, 50 million. So I don't think that they can afford the 79 million payout for the 5.5%. So first thing I'm going to do is cut that in half, which already makes it so it doesn't quite hit our yield, because that would be a 2.8% dividend yield. So still well above the market, which is great to see. But and I guess if the price were to fall a bit more, you could get to that 4% yield. So keep that in mind. But for right now, I just don't think they can hold that 79 million payout in relation to what I'm seeing in their 5-year average free cash flow. So it looks like in the most, they issue a lot of shares. Okay, that's not great. And they pay down debt, which is good. I mean, the thing about your stockholders is that they aren't required to get an interest rate, whereas the debt, you're required to pay it. And so, I mean, if they had a lot of debt, maybe that'd be smart, but I don't think, like, they have 260 and let's say 40, 50 million on average. You're looking at probably 6 times your 5-year average free cash flow and long-term debt, which is more than I'd like, but it's not like an excruciatingly amount. Just interesting that they would issue so many shares when they really don't need to. Companies' use of their free cash flow just sometimes bewilder me. It's just insane. Like, if they didn't pay down, or if they didn't pay such a big dividend, then they wouldn't have to issue shares to pay down debt. They could just pay down some of the debt along with the free cash flow that they have. It's just weird, because there's 2 things a company can do to raise money. They can issue shares or issue debt. And so if you make positive free cash flow, which again, on a 5-year average basis, they do, they just don't need to do that. And so it's just a weird capital allocation move that they're doing. Looks like they're just issuing shares to buy down a little debt, which can be safe in the long run, but definitely hurts the shareholders who are currently holding on to the shares because they're just getting diluted. So, I mean, if we're looking at the business, it's just up and down, up and down. I'm just going to assume 0%, 10% on the PE, price to free cash flow, for no growth business, or a business that relatively stays around the flat average, 15% return, maybe 5%, 8%. I mean, I'm just taking an average really, and 3, 7.5. So maybe I'll do 4 and 6. Share change. They've issued a lot of shares. So yeah, this is not looking the prettiest. We're saying the company's price would need to fall 79% before we get a 15% return on the stock. Again, right now, I think they're going to have to cut that dividend. They're not going to be able to afford a 79 million payout given their free cash flow. But if the farther they go, they can drop that dividend in half or even by a third. And if the company's the stock price falls 80%, that's going to bump the yield up. And so for now, just waiting. I'm not rushing to do any research on this, but hope everyone has a great rest of their day. Thank you.